Welcome to 𝘠𝘵𝘪𝘶. I am Mr. 𝘕𝑗𝑗, and I want to take you through a topic in advanced financial reporting and analysis known as external reconstruction. External reconstruction. So you write external reconstruction. You write below that. It arises when an existing company, or a new company is formed, to take over the business of the company under reconstruction. To take over the business of the company under reconstruction. Full stop. Then you write below that. The following are the major differences between an internal and an external reconstruction. The following are the major differences between an internal and an external reconstruction. Number one, in an internal reconstruction, no new company is formed. But in an external reconstruction, a new company is formed. To take over the business under reconstruction. Another difference, number two, an internal reconstruction is lengthy. An internal reconstruction is a lengthy and tedious process. While an external reconstruction does not involve lengthy and tedious procedures. While an external reconstruction does not involve a lengthy and tedious procedure. Another difference, number three, an internal reconstruction requires a court order. While no court order is required, in an external reconstruction. Another difference, number four, in an internal reconstruction, accumulated losses are written off. While in an external reconstruction, while in an external reconstruction, the accumulated losses are taken over, while in an external reconstruction, the accumulated losses are taken over by the new company. The accumulated losses are taken over by the new company. So those are some of the differences between an internal reconstruction and an external reconstruction. Now, let's get to the accounting procedures, the accounting entries. Accounting entries in an external reconstruction. Accounting entries in an external reconstruction. Number one, with the book values of the assets, taken over by the new company, with the book values of the assets taken over by the new company, debit realization account, credit asset account. Number two, with the book values of liabilities taken over, by the new company, debit liability accounts, credit realization account. Number three, with the amount of purchase consideration, paid to acquire the old company, the amount of purchase consideration paid to acquire the old company, debit selling company account, credit realization account, Number four, with the amount of preference dividends in arrears, debit realization accounts, credit preference sundry members account, you credit preference sundry members account. Number next, with the amount of liquidation cost incurred, debit realization account, credit bank or rather cash. Number next, with the amount of ordinary stroke preference share capital with the amount of ordinary stroke preference share capital. Debit ordinary stroke preference share capital account. Ordinary stroke preference share capital account. Credit ordinary stroke preference sundry members account. Credit ordinary stroke preference sundry members account. Number next, with the assets written off, debit ordinary sundry members account, debit ordinary sundry members account, credit asset account, credit assets account. Number next, with reserves written off, debit reserve account, debit reserve account, debit reserve account, debit reserve account, credit ordinary sundry members account, credit ordinary sundry members account. Number next, with the accumulated losses written off, debit ordinary sundry members account, debit ordinary sundry members account, credit profit and loss account, credit profit and loss account. Then below that you write entries in the books of the new company. Entries in the books of the new company. Entries in the books of the new company. Number one, with the takeover values of the assets, debit asset account, credit business purchase account, credit business purchase account. Number two, with the liabilities taken over, debit business purchase account, debit business purchase account, credit liability account, credit liability account. Number three, with the amount of purchase consideration, debit business purchase account, credit vendors account, credit vendors account, or rather the seller's account. the vendor's account, or rather the seller's account. Number next. To record settlement of purchase consideration. To record settlement of purchase consideration. To record settlement of purchase consideration. Debit vendor's account, or rather the seller's account. Credit ordinary share capital, stroke preference share capital, stroke debentures, stroke cash, as the case may be, depending on how the purchase consideration has been settled. It can be settled by issue of ordinary shares, or issue of preference shares, or issue of debentures, or payment through cash. Finally, the last step. With the balancing figure in the business purchase account, with the balancing figure in the business purchase account, representing either goodwill, or capital reserve on acquisition of the old company, representing either goodwill or capital reserve on acquisition of the old company. You put a colon, you put a full colon, you put a full colon. If goodwill, debit goodwill account, credit business purchase account, credit debit goodwill account, credit business purchase account. Then, if capital reserve, debit business purchase account, debit business purchase account, credit capital reserve account, debit business purchase account, credit capital reserve account. So that means that if the balancing figure is on the credit side of the business purchase account, then it means there was goodwill on acquisition of the old company. And if the balancing figure happens to be on the debit side of the business purchase account, then it means there was a capital reserve on acquisition of the old company. And therefore, basically those are the entries that you need to make in case of external reconstruction, both in the books of the old company and in the books of the new company. Therefore, in our next session, we are going to proceed by tackling a past paper question pertaining the same. Thank you.